Hi, this is Professor Nugent, and today I'm going to review Chapter 4, which is a review of accounting. Now, what we're going to be reviewing is we're going to be looking at the balance sheet, income statement, and statement of cash flows, not at the point of view of an accountant, but more the point of view of a financial manager. And we're going to talk about the importance of depreciation, how depreciation affects cash flow, taxes, and how to calculate a marginal and average tax rate. Now, accounting can be tedious, it can be boring, it can be hard, and finance people just plainly don't have the time for it. So they needed a better way. So they came up with shortcuts or different ways of interpreting financial data to make it a little bit easier. Because, finance people, especially if you don't have a classically trained accounting background, we're going to find accounting and the analysis of accounting hard. There's a picture of my old accounting teacher. That was his, happy face. Anyway, the firm's financial statements. These are the reports that summarize the firm's activity. And the income statement is one that we're going to be focusing on a great deal in this class. And it's going to be the concepts of the income statement, or the income statement itself, will be incorporated into many chapters that we go through in this finance class. Now, the income statement, the income statement is sort of almost like a paycheck, where you start out with your gross amount that you're bringing in, and you end up with your net amount after all your expenses. So at the top end of any income statement, we have our net sales, sometimes called revenues. We take away the costs of the items that we're selling, and we come up with our gross profits. Now, the gross profits, we have to take away our depreciation expense, selling and administration expenses, that's S&A, sometimes called SG&A, selling and general administration expenses. And that is really going to be, you are going to be in that category. So when you graduate college and you work in marketing or sales or finance or accounting, you're going to be in this SA expense. And you're one of the people needed. You don't actually make the product, but you're behind the line supporting the product, either through sales or administration. So once we have our gross profit, we take away our depreciation expense, the expense of S&A, and then we get our operating income. From the operating income, sometimes known as EBIT, we take away our interest expense, and then we calculate our taxes, take away our taxes, and we have our net income. Very simple. You take your net income, divide by the amount of outstanding shares, and you get your earnings per share. Now, from your net income, you can only do two things with your net income. You could either pay it as dividends or increase your retained earnings. It's the only two things that a company can do with its net income. Okay, now let's look at, in class, when we finally get back to the class, we will be working on actually doing an income statement in class and a few examples of that. But now let's talk about the balance sheet. So the balance sheet, there's a simple equation. Assets equal liabilities and owner's equity. So any assets a corporation has were purchased through either borrowing money, which we call liabilities, or owner's equity, money that the owners gave to the company. Now, the asset section is we break it into current and fixed. The current assets are the short-term assets that change rapidly, like cash, inventory, accounts receivable. The fixed assets are things that are around a little bit longer, such as, I'm just going to move this a bit down. There we go. Such as plant, equipment, and when we have plant and equipment, a lot of times we have to subtract from that accumulated depreciation. And depreciation is a concept that assets don't last forever. So you buy a new car, and then 3 years later when you go to sell the car, you're not going to get the same amount of money for it because it's depreciated. So in accounting land, we have to monetize the amount of depreciation to keep our assets as close to their true valuation as possible. Now on the liability side, we have our current liabilities, accounts payable, accruals, which are sort of like prepayments, and short-term debts, sort of like credit cards. And then we have a long-term liabilities, bonds, bank debt, mortgages, preferred stock. These are longer term, they're not due within 12 months. They can be many years. On the owner's equity side, we have our common stock, which represents ownership in the company. There may be capital in excess of par. So par is an accounting statement of what each share of stock is worth. So if people, when they purchased that stock, paid more than the par value, which is usually $1, we call that capital in excess of par. And then retained earnings. And retained earnings is any money, net income the company makes that they keep and don't pay out as dividends to investors. Okay, so here's a balance sheet. And balance sheets usually we're looking at, we like to compare balance sheets. So here's the 2009 versus the 2008, and we can see the change. So cash went up, accounts receivable increased, inventory went down, marketable securities went down. So we look at the change. And overall, our total assets increased by 5,000 from 2008 to 2009. So a lot of times when you analyze balance sheets, you want to see year over year how things are different, because we want to see a strong balance sheet. When we say a strong balance sheet, we mean a balance sheet where the assets are growing and they're funded hopefully more by equity and retained earnings than loans. Okay. So that would be one half of the balance sheet. Now the other side of the balance sheet would be the liabilities and owner's equity. So here, if we look at this closely, we see that they have to match. So total assets and total liability and equity are both equal. And there's been an increase in the change is equal as well. So whatever assets they increased over here, there's been an increase in certain liabilities or equities to pay for those assets, and that's how we keep the balance sheet balanced. Now, going back to the income statement, we're going to talk about this again. It's a very important concept in finance, and we're going to be doing a lot of work in this class in multiple chapters, and also it's something you should be reviewing and looking at in the Zoom simulation as well. So, in the firm's financial statement, the income statement, we have our revenues, which are sales, minus any expenses, and then we have our net income. As in a very large sense, that would be the formula for the income statement. So revenues can actually be, sales is generally the biggest revenue, but we could have investment income in capital gains, dividends, or interest received on some of our assets. And on the expense side, we have what sometimes COGS, cost of goods sold, and this is the actual cost of the products we're selling. Salaries for employees, depreciation expense, taxes, other expenses, interest that we pay to the bank, and then those are probably the biggest categories in the revenue, and then the expense side. Okay, so net income, like I said before, there's only two things you can do with net income: pay dividends or increase your retained earnings. Now let's talk about the statement of cash flow. Okay, so the statement of cash flow, money coming in, money going out, minus the money going out, equals a change in cash. So pretty simple, right? You have $500 comes into your pocket this week. You spend $300 on buying stuff. So their change in cash is $200. So we can look at the cash flow, one area from operations. So what kind of cash sales did the company generate? Collection of accounts receivable, decrease of inventory, all depreciation expense. These four areas, these are considered increases to cash flow from operations. Decreases or cash outflows can be considered, payment to suppliers, payment of salaries, increasing the accounts receivable, which means we're lending money to other people, decreasing payables, we're paying money to decrease our accounts payable, or decreasing accruals, which an accrual is an account where we're getting things but not paying for them. So they're in an accrual basis, so we're accumulating this money we owe other people, and then at some point we decrease the accruals, and that costs us cash. So operations, we get cash flow in from the business and cash flows out from the operations of the business, and the difference would be the change in cash. Now, companies also have investments. So any sales of fixed assets could create a profit. So the purchase of fixed assets or a purchase of other firms will create can create a cash outflow. So if we sell a division or assets, we're going to generate a cash inflow from investments. And if we make any investments, any purchase of fixed assets or any purchase of other firms, that's going to make a cash outflow. So companies' cash will be affected from the corporation's investments. And finally, we have financing. So there could be a cash inflow if your company sells stock, they issue long-term debt or notes payable, they will receive cash for doing these activities. But the cash outflow on the financing, if we buy back stock, repay long-term debt, pay dividends, pay interest, this is going to reduce our cash outflow. Increase our cash outflow. Just like in the Zoom simulation, in the beginning of Zoom simulation, you can request additional funds through the sale of stock and long-term and short-term debt, and then as you move forward in the simulation, you start making significant amount of net income, you can start buying back stock and paying down debts, and that's going to change your cash flow. And if you look at the financials page of the simulation, you'll see these financial statements there as well. And I encourage you to look at these financial statements in the simulation to get an idea of what's happening when you make these decisions on your company. Okay, so you take the three of these together. You take the change in cash from operations, add it to the change in cash from investing, and add that to the change in cash from financing, and you have the total change in cash for a company, and that's basically the cash flow statement. Now, market versus book value of assets. So we have market value and book value, and they can be very different. So the easiest way to kind of think about this is maybe think about a car. You look on Kelley Blue Book and you see that the book value of a car is $15,000, but you wind up selling it for $17,000. So there, the market value was higher than the book value. So rarely is the market value the same as the book value. So the book value is really just, you know, this is what we think it's worth. When we actually sell the asset, or the market values the asset, that's a market value. So book value is recorded as an initial cost. And the changes in book value is what we call depreciation. And we follow very specific accounting rules that help us to understand when we're allowed to reduce the value of the asset. So the IRS gives us percentages and helps us to understand, it tells us how to reduce the value of our assets, and that's called depreciation. To try and keep the actual value, the book value of the asset as close to market value as possible, and that's sort of the role of depreciation. The factors that are going to determine the difference between market and book, one factor is going to be if there's a difference between the market value and the book value of an asset, that's called disparity. And things that can make that occur is the time since acquisition. So the more time, generally the more difference there can be in the value of the asset. Inflation can also affect the value of the asset. So if you bought your asset and your country goes through a high period of inflation, you may be depreciating your asset, but because to buy this asset new, the price has gone up so much, sometimes it creates a real difference in the book value to market value, because now the new assets, say the asset is now, you bought it for $15,000, 5 years later they're selling for $25,000. That increase in price of the new sale price actually makes your older piece of equipment more valuable because of this inflation. Now, one thing you could see this in is in computers. Sometimes, not lately, but throughout the 90s and part of the 2000s, the price of computers dropped really quickly. So, you know, it used to be to buy a decent computer, you'd have to spend $3,000 to $5,000. Now, you only have to spend $300 to $500. So some of those older computers were really made worthless a lot faster than their depreciation, because there was a deflation in the value of computers as the prices went down. And we also have things called tangible versus intangible assets. So those are very hard to really understand how they change in value. and there's generally more difference. So an intangible asset could be sort of when Disney purchased the Star Wars franchise. So they purchased the Star Wars franchise from George Lucas, and they paid $4 billion for it. What's the true value today? Now that they're going to be releasing new movies and making new TV shows and new merchandise, it's an intangible asset. It's much harder to judge what the value of it is today. But the best way to judge the value of an intangible asset is when it's actually sold. So we know that, a couple of years ago, if you asked me, how much do you think the value of George Lucas's Star Wars company is worth? I would have no idea. I would never have guessed it was $4 billion. But since Disney paid $4 billion, that's now what the value, or when they purchased it, the value of that intangible asset. So intangibles are a lot more difficult to put an actual price tag on. Now, when we talk about book value of liabilities, now with assets, the market value, as it's similar to assets, but the market value of liabilities can be different than the book value, and but the relationship is less complex. The main factors, the difference between the book value and the liabilities, is the health of the firm. So let's think about this for a minute. When I say the book value of liabilities, the company issues bonds, and this is generally what we're talking about, is the bonds. So they issue $100,000 worth of bonds, and if the company's health deteriorates, the market value of those bonds will also go down. So if it looks like the company's in financial trouble, the bonds will start trading at a discount. So the market value of the bond, the book value is going to be $100,000. That doesn't change, but the market value may be $70,000 because investors have traded the bond lower because they don't feel the company is as strong. So there could be develop a good difference between the book value of the liability and the market value based on the strength of the company. Now, if the bonds mature and the bonds are paid off, the market value and the book value of the bonds will always be equal at maturity. So they do, at some point, they come back together and they develop the same price, because now the company is going to pay back the bonds exactly what they promised. So the book value becomes, $100,000 is paid back, so the book value and the market value are identical. So the bonds will only be difference in market and book during the years it's trade. Once it stops trading, is paid back, this difference is gone. Okay. Now, if we talk about the total market value of equity, that's actually pretty easy to calculate, because you just take the number of outstanding shares of stock they have and multiply it by the stock price. And that gives you a market capitalization, or the total market value of a company. So if you took Microsoft and you took its, 4 billion shares and multiplied it by $30 per share, you get a $120 billion company. And so the market value of equity is very easy. Whatever the stock price is times the total amount of outstanding stock, and that's the market value of the company, of the equity. Now the book value, this is really assets, minus liabilities will be the book value. So the shareholders' equity is also assets minus liabilities. So book value is the same thing as shareholders' equity, and it reflects any changes in the assets or liability accounts inside the company, specifically on this balance sheet. So if you hear the term book value, think shareholders' equity, because the two are identical. Okay, now let's get to depreciation. Let's talk about depreciation. Now, just let me give you a second here. This lecture is a lot more comprehensible after you've read the chapter. So if you're finding that as I'm going through this lecture, that you're a little confused or not sure about certain things, that's because you haven't read the chapter. So I would suggest, stopping here, reading the chapter, and then starting this lecture all over again. Because if you feel like I'm going too fast, or you don't quite understand everything, is because this lecture assumes that you've read the chapter. And one of the things that most people have a problem with is depreciation. So when I'm going over depreciation, you may not really understand it too well unless you've read the chapter on depreciation, in the part inside the chapter on depreciation. Now, accounting depreciation is basically taking the asset's initial cost and allocating it over different periods of time to reduce the value of the asset. So depreciation is an allowable expense as determined by the IRS and the accounting rules. So when a company buys an asset, they're able to reduce the value of the asset. Almost this depreciation is an expense. So when I reduce the value of my assets, I'm able to reduce the net income of my company, or the operating income of my company, and the net income. If I reduce the operating income of my company by creating depreciation expense, my taxes are lower. But this depreciation is really a non-cash charge. It's just sort of like when your car depreciates, you know, you have a car for 10 years and the value of it depreciates. Does any cash come out of your hands? No, it's just the value of the assets are lower. But you as an individual, you're not allowed to put on your tax statement a deduction for the depreciation of your car, but companies are. So companies keep track of their assets very closely, and as they're able to write off a part of their asset, they get a tax benefit. So there could be a company that's very profitable, but if they wound up depreciating a major asset greatly, they could show a loss, a net loss for the year, even though the company generated millions of dollars of cash flow because of this depreciation expense that we can calculate. So this is sort of like a tax advantage for companies. So they like to accumulate the depreciation as fast as possible because it helps reduce their taxes and increase their cash flow. Now, when we calculate depreciation, the total amount of depreciation, we want to look at the total amount of depreciation over the life of the asset. So the IRS determines how long certain assets will live. And it's going to equal the cost of the asset plus any delivery costs or setup costs. So say the company was ordering furniture and there was a $100 charge to deliver it and another $100 charge to set it up. That would all be in the base asset price of the asset. Now there are a couple different methods of calculating depreciation. One method favored by most accounting classes is straight line depreciation, and it's very simple. And you just divide the accounting life into equal amounts. And so say you have a $12,000 asset, so you divide that, let me make it a $13,000 asset, and you divide that by what we say the equal amounts of depreciation. So if we had a $13,000 asset and the asset's good for 12 years, we could depreciate it over 12 years, we're actually going to have 13 depreciation periods because the first and last year are thought of as six months. So we'd have, the first year would be $500, then we would have 11 years of depreciation, and then last year would be another 500. So the first and last year are really 6 months. So it's a 12-year asset would be 13 periods of depreciation. So whatever asset life, it's a 10-year asset life, it is going to be 11 years of depreciation because we break up one period into two 6-month periods. So the straight line depreciation is a way of making it simple and just dividing by a number to get equal amounts of depreciation for each period of time, except the half-year convention. So if it was $1,000 every year, the first and last year would be only $500. Okay. Finance people like the modified accelerated cost recovery system. These are specific percentages that can be depreciated each year, but we like this system because it depreciates more in the beginning and less at the end, so we can depreciate the asset faster and get more tax benefits. If we could, we'd prefer to depreciate the asset completely in the first year because that would give us the maximum amount of tax deductions that are soonest. You know, because we don't want to wait 10 years to get all our tax deductions. We want them now. The sooner the better. So let me give you an example. So there's a piece of equipment that costs $9,000, and there's an extra. The cost of delivery installation is $1,000, so that makes it a $10,000 asset, and the accounting life is for 3 years. So So that means we have to depreciate it over 4 years because of the half-year convention. The first year and the fourth year 6 months. So the schedule will provide us with percentages. So our basis never changed. So we take our basis, or 10,000, and we multiply it by each percentage. 10,000 times 33%, 3,330. 10,000 times 44.5%, 4,450. 10,000 times 14%, 1,480. 10,000 times 7.4%, 740. So we take our basis, our 10,000, and we multiply it by the percentage that the IRS tells us what these percentages are, and the IRS tells us what assets fit into which category and how much to depreciate it by, and then this is the amount we could take on our income statement as a depreciation expense for each of these years moving forward. Now let's talk about taxes for a minute. Marginal and average tax rates. So these recently changed. Obama changed these recently, and they increased some of the top end tax rates. But corporations have different tax rates than individuals, and the taxes are progressive. So your marginal rate is your highest tax bracket that you've reached, and your average rate is averaging all the taxes you paid at all the different tax brackets. So the marginal rate, again, is the next dollar you earn, the amount of tax you pay on the next dollar is called the marginal rate. The average rate is simply dividing the total taxes paid by your total income. And this is why we call it a progressive tax system, because the average tax rate increases with the level of income you make. And the marginal, let me just restate that. The average tax rate, right, increases with the taxable income. So as you make more money, you're paying money in higher tax brackets, your average rate is going to slowly increase. Now the marginal rate is always greater, well, generally always greater than the average rate. But the corporate tax schedule is not as progressive as an individual tax schedule, because there could be some exceptions to this rule, because it's progressive to a point and then it flattens out, which we'll see here. Now here are the tax rates as of 2009. This may have changed, but you can see that we go from, the first 50,000 all companies make, they pay 15%. The next 25,000 all companies make, they pay 25%. And then the next 25,000, so now they made 50, 25, and 25, or a total of 100,000. They go up to 34, and then all the money they make above 100,000 to 335,000 gets taxed at 39%. But then it goes down to 34 again, up to 35, up to 38, and then back down to 35% if you make over 18 million. Okay, so you can see how these tax brackets jump around a bit for corporations. Now, when you calculate taxes, so we have the corporate tax brackets, and what we basically do, so say this company here makes $160,000, and we want to see how much taxes are they going to pay on the 160. And we need to break this 160 up into the different brackets. So I could stick 50,000 in this first bracket from 0 to 50. So I could put 50,000 there, and we pay 15% tax, or 7,500. So now, since they made more than 75,000, there's another 25,000. That's the number between 50 and 75,000 that I could fit in the second bracket, and they pay 25% on that. Our total is 625. Now, the third bracket is up to from 75,000 to 100,000. So I can put $25,000 I could fit in this bracket, because that's the number between 75,000 and 100,000. So and that's going to be at 34%, so that's 8,500. Now, in the fourth bracket, there's room in the fourth bracket from 100,000 to 335,000. However, I can't fill this fourth bracket. I only have, if I count the money I've allocated already, 50, 25, 25. So I've allocated 100 of this $160,000 in the first three brackets. So the fourth bracket is the remaining 60,000. So if I add 50, 25, 25, and 60, that's my $160,000 worth of income as a corporation, and these are the tax rates I paid at the different levels of earnings. So my last 60,000 I paid 39%, or 23,400. So if I add up all the taxes I paid in each bracket, if I'm a corporation that makes $160,000, I'm going to be paying $45,650 in taxes, federal taxes. Okay, now let's look at marginal and average rate here. Okay, so here are the four tax brackets. Now, my marginal rate is 39%, which we saw here. This is the marginal, last tax bracket that I'm in. So the last tax bracket I'm in here is the fourth one, and it's at 39%. So that is my marginal tax rate, the highest bracket I'm in. Now the average tax rate, I'm going to take my total taxes. Remember the 45,000 over here? I'm going to take the 45,000 divided by the 160,000, and that becomes my average tax rate, sometimes called blended. Okay. Now, there are different tax treatments for interest and dividends. So interest paid on corporate debt is a tax deduction, a taxable deductible expense. So if we pay interest on our debt, we're able to deduct it off our income. Now, dividends paid to common and preferred stockholders is not tax deductible. So I do not receive a tax benefit for paying dividends. So that's important to realize. Now, interest paid on corporate debt is a tax deduction expense. And like I said before, dividends paid to common and preferred stockholders is not tax deductible. However, there's another dividend. Companies can receive dividends if they have stock in other corporations. So companies can actually buy stock in other corporations, have ownership of other corporations. And when they receive dividends from these other corporations, 70% of those dividends are excluded from tax. So only 30% becomes taxed of dividends they receive from other companies. So, for example, Corporation B owns 100 shares of Corporation A. Corporation A pays a $2 dividend per share, so Corporation B is going to make $200 in dividends from ownership of Corporation A. Now, only 30% is taxable, so they're going to pay tax on $60 of the $200, and the other $140 or 70% is tax-free. So if they had a marginal rate of 25%, they're going to pay $15 on this dividend income. So that's a real benefit for corporations. I'm not exactly sure why they get this benefit, but it'd be nice if individuals had such a benefit as well. Okay, so that's the last slide in this chapter, and that's the basic review of accounting. So now I want you to read over Chapter 4, if you haven't already done so, and be prepared, because in the next class we'll be going over handouts. So always have a calculator and pencil ready, have that ready with you, because I'm going to be bringing handouts, and we're going to be going over handouts that are going to reinforce the concepts that we learned in Chapter 4. Thank you, and see you soon.